Hi, this is Darin Mangum, securities lawyer, Mangum and Associates. I thought I'd get on today and talk about the recent Silicon Valley Bank bailout, or I should say failure, and then it looks like the government is bailing them out, bailing out all the depositors. And I can't, from a securities law perspective, there's lots of things that banks can do that if you're a private fund or a company, you just be left hanging out to dry, right? But, banks are banks. So if you've got a central bank that comes in to rescue you, then, hey, that's an advantage to owning a bank, right? I wanted to comment on, and this is an ongoing story. It's all over the news, obviously. Silicon Valley Bank, as you probably know, failed, was taken over by the FDIC regulators. Also Silvergate Bank, Signature Bank, all begin with S's for some reason. So maybe don't name your your company after with an S. But anyway, wanted to just get on and talk about it from a securities law standpoint. And some people might say, well, this is obviously a banking issue. What does it have to do with securities? Well, a couple things. Certainly the exposure that the bank was subjected to in the because banks, they turn around with your deposits and they go and invest in securities. And obviously the big problem with that is they bought very low yield bonds, very long yield maturities. And whenever you have a run on the bank, which apparently happened, which obviously happened over the course of a few days, you're all of a sudden now you have to sell. You've got to sell those bonds at a huge discount because obviously interest rates have been going up. And the question is out there, well, why did they take this kind of position, and why didn't they take action earlier? To liquidate these bonds, because they knew everybody's known that interest rates are continuing to go up. The Fed is continually increased interest rates over the past year or so to fight inflation. And so knowing that, and your exposure is in these low yield long-term bond securities, okay, well, it's just a recipe for disaster, right? In the event that there was a bank run, and sure enough, there was a bank run, right? And so, just not a good position to be in a bank. As it relates to securities enforcement, I mean, that's obviously a strategic move that, okay, everybody can guess, well, should they have liquidated those bonds earlier? I mean, but obviously it's clear that, in any case, that they knew that they were possibly exposed. And I think a lot of other banks are realizing, hey, maybe we're exposed to the same thing that might happen. But the issue is, well, did the chief executives, knowing that information, knowing that there was a potential exposure, there's a new SEC investigation into their sale of stock just a week or so before all this went down, right? Both the CEO and the chief financial officer both sold shares of the bank the week before the bank collapsed, both netting them about $2.3 million, right? Which sounds kind of suspicious, like, well, that's kind of obvious, right? Now, they did set this up under what we call a 10b5-1 plan, which allows for a company executive to sell their shares as long as they do it in they file it 30 days earlier. The SEC has recently tightened those rules to make it a 90-day window instead of a 30-day window. But still, the day that rule, this new 10b5-1 rule went into effect, that was the same day that these executives sold their shares, right? Why did they sell their shares? It's like, well, did they see the writing on the wall? And I mean that's what the SEC investigation is going to be about, right? And so, how does this relate to? We should talk about how this relates to maybe a private company, especially one that's raising capital issuing disclosure statements, whether you're doing regulation crowdfunding or Regulation D, Regulation A, or if you're a public company client of ours, or if you're not a client of ours, you should certainly look at, possibly, obviously look at a 10b5-1 plan if that's your case. In the case you want to start taking money off the table, start selling shares, but certainly you have to do it in a way that is pre-planned and destined. But even with that plan in place, you definitely don't want to, and even if you don't have a plan in place, you definitely never ever want to be perceived as selling at when the ship's going down, or or hey, there's a hole in the boat and we're leaking, or we're taking on water. Okay, that's the last time you want to think about selling. Now, I mean, certainly that's the urge, right? But you always have to look at it, how I mean, ethics aside, right? I mean, obviously ethics would tell you, hey, you don't want to leave your shareholders high and dry. You're a fiduciary for your company. You want to do the best for them. But ethics aside, right? You certainly don't want to get into legal hot water as far like you get an insider trading investigation, or just certainly possibly if it's this big, like Silicon Valley Bank. I mean, when so many people lose their shirt. Now it looks like the government's going to bail everybody out, which that's great, but I don't think they're going to do that for everybody. I mean, who knows, right? It's just weird times. I mean, what's weird when you've got uninsured depositors above the 250,000 FDIC insured level that are getting bailed out. I think because I think the Treasury Department said, hey, this is a systemic risk. It's extraordinary, so therefore, we're going to step in and make everybody whole. Okay, well, that's great. I mean, that's just fortunate for Silicon Valley Bank. Great, but their shareholders, or I mean, certainly their shareholders are going to lose out because the bank has been taken over, but because now the government owns it, right? But still, the depositors, I think, who it's kind of a partial bailout because depositors are fine. I mean, that's really what the whole insurance thing is all about. But anyway, the whole news story brings up just a number of issues that I think are relevant. Again, whether regardless of whether you own a bank or not, you definitely want to, especially before you go selling a big block of your shares. Certainly, if you especially if you internally have knowledge and information that your investors don't have, and you take action on that really, bottom line, that exposes you to potential liability, right? Not the failure to disclose material information. That's just fundamental tenet of securities law. But anyway, interesting story. We'll see where it goes. Anyway, appreciate you checking out our YouTube channel. If you like this content, please subscribe. If we can help you in any way with your securities law matter, please reach out to us. And we'll look forward to seeing you on the next video. Thank you.